So, let's talk about one of the most heated debates in the corporate world right now, Tesla's proposed 2025 CEO pay plan. It's a real lightning rod, and today we're going to break down exactly what it is and why a major investor is throwing their full support behind it.
I mean, just to set the stage here, the goals in this plan are so massive, they're measured in the trillions. We're not just talking about a pay package. This is a statement of ambition on a scale that, honestly, we've never really seen before.
And to help us get our heads around it, we're going to look at this whole thing through the eyes of a major long-term shareholder, the State Board of Administration of Florida, or SBA for short. Their perspective gives us a really clear window into the financial case for this pretty controversial plan.
Okay, so before we dive into the why, let's get into the how. What are the nuts and bolts of this thing? How does it actually work?
It all boils down to these three simple but really powerful principles. It is a completely all-or-nothing deal. The CEO gets zero guaranteed compensation. No salary, no cash bonus, nothing. Every single cent is tied to hitting some incredibly tough targets. It's the definition of pay for performance.
And when we say tough targets, just look at these numbers. The plan is split into 12 chunks, or tranches, kicking off at a $2 trillion market cap and climbing all the way up to $8.5 trillion. And here's the key part. This isn't about the stock just spiking for a day. To unlock anything, the value has to be sustained over both 30-day and 6-month averages. We're talking about real, durable growth.
But it's not just about the stock price ticker. That's just half the story. The plan also demands hitting huge, concrete business goals. Things like 20 million cars delivered, 1 million robo-taxis out on the streets. This makes sure that any growth in the stock price is actually backed up by real-world success and solid financials.
And here's the kicker that really emphasizes the long-term thinking. Even if, and it's a big if, these milestones are met, the shares can't just be cashed out. Nope, there's another 5-year holding period after they vest, so the whole thing could stretch out for more than a decade, completely locking in the CEO's interests with the shareholders for the long, long haul.
All right, so you see the pieces. How do they all come together to convince a huge institutional investor like the Florida SBA? Let's dig into their case for saying yes.
The SBA's argument is actually pretty simple. They're basically saying, we've seen this movie before, and it has a fantastic ending for shareholders. They point back to the 2012 plan, which led to a 17 times increase in value. Then the 2018 plan, which took Tesla from about $50 billion to $650 billion in just 4 years. So for them, this isn't some new, crazy risk. It's just doubling down on a formula that has already worked wonders.
And if you want one number that sums up that track record, here it is. 20,000%. That is the insane return shareholders have seen since that first performance plan was put in place. From the SBA's perspective, this is the ultimate proof that the model works. It aligns everyone and delivers absolutely historic results.
This quote from the SBA really gets to the heart of their whole philosophy. Their point is, because the CEO only gets rewarded after shareholders have already seen these massive gains, their interests aren't just similar, they're identical. The risk is shared, and so is the reward.
So, in the SBA's view, this plan isn't just some wild idea. It's actually an example of really good corporate governance. I mean, it checks all the boxes, right? It's pure pay for performance, it creates direct alignment with shareholders, it has those long holding periods, and it even addresses leadership continuity.
Okay, but what about the elephant in the room? The biggest knock against this plan is its absolutely staggering size. So how does the SBA, as a fiduciary, remember, respond to the argument that the payout is just way too big? And here's the core of the debate, right here. The critics look at the absolute dollar amount going to one person, but the SBA says you can't look at it that way. You have to look at the value created for everyone else. Their argument is simple. You can't judge the cost of the investment without looking at the absolutely massive potential return.
This chart really paints the picture. The SBA crunched the numbers, and they figure if all the goals are hit, this plan could create $7.5 trillion in new value for shareholders. Now, the cost of that is about a 10% dilution from the new shares. For them, that's a trade they are more than happy to make all day long. And here's where the SBA gets a little pointed. They argue that a lot of the criticism isn't really about the financial mechanics at all. They claim that many opponents are focusing more on feelings about inequality or personality instead of just doing the cold, hard math from a shareholder's point of view. So, where does that all leave us? Well, the SBA is basically putting this forward as more than just a pay plan for one company. They see it as a potential new blueprint for how you incentivize truly game-changing, transformative growth. And that really is their final verdict. The State Board of Administration of Florida believes that because of its proven history and all the safeguards built in, this plan doesn't just work for Tesla, it sets a new gold standard for how executive pay should work, period.
And really, that's the big question at the center of this whole thing, isn't it? If you want to achieve something truly extraordinary, a real moonshot, is a reward of this size not an excess but, maybe, a necessity? How we answer that could change the way we think about ambition and pay for a long time to come.